Hello everyone. Welcome back to Market Meridian, your go-to channel for in-depth commodity analysis and actionable trading strategies. Today is April 27th, 2026, and we are diving straight into the most pressing assets in the global market, crude oil and gold. If you've been blindly going long without checking key support and resistance levels, this video is a must-watch. We are breaking down today's market chaos, technical patterns, geopolitical triggers, and clear risk management rules. No fluff, just data-driven insights to help you trade smarter, not harder. Let's get started. First, let's set the stage with a global market overview to understand why oil and gold are moving in such extreme, volatile ways right now. Over the past 60 days, we've witnessed a historic divergence and simultaneous chaos across commodities, driven by one dominant force: escalating geopolitical tensions in the Middle East. What started as localized conflicts has now paralyzed the world's most critical energy choke point, the Strait of Hormuz. For those new to this, the Strait of Hormuz is a narrow waterway that carries 35% of the world's crude oil, 20% of global LNG, and over 56% of seaborne sulfur trade every single day. Since late February, military tensions have brought shipping through the strait to a near standstill. Daily oil flow has plummeted from 20 million barrels to under 400,000 barrels, with some days seeing zero transit. This isn't a temporary glitch, it's a systemic supply shock that has rewritten the rules for oil pricing entirely. On the other side, gold, the ultimate safe haven asset, has been caught in a brutal tug-of-war. For 4 straight weeks, gold rallied nearly 30%, hitting all-time highs above $4,832 per ounce, fueled by geopolitical fear and global central bank buying. But last week, it suffered its first weekly loss in 4 months, dropping 2.51% to close at $4,708.79. Why? Because soaring oil prices have reignited inflation fears, forcing markets to push back expectations for Federal Reserve rate cuts. A stronger US dollar and rising Treasury yields have capped gold's upside, even as geopolitical risks remain elevated. So today, we have 2 assets moving for conflicting reasons: oil driven by supply collapse, gold driven by inflation versus safety, and both are trading at critical technical inflection points. Blindly going long here is a recipe for losses. Let's break down crude oil first, step by step. Part 1. Crude oil analysis, geopolitical chaos and key price zones. Let's start with the star of the market, WTI crude oil and Brent crude oil. As of today's pre-market, WTI is trading near $94.80 per barrel, while Brent hovers around $112.30, both up over 22% in the last 2 months, with last week alone seeing a 14.88% surge. This isn't speculative hype. It's a direct response to real, irreversible supply disruptions. Let's confirm the hard data first. Gulf oil production has been cut by 57% due to facility damage and shipping bans, removing 13 million barrels per day from global supply. The International Energy Agency, IEA, warns that global crude inventories are depleting at an unprecedented rate, with potential losses of 1.3 billion barrels if the strait closure persists. There is no quick fix here. Land pipelines can only replace 3.6 million barrels per day, less than a third of the lost supply. This means the geopolitical risk premium in oil is not going away anytime soon. Goldman Sachs, JP Morgan, and Citi all warn that if the Strait of Hormuz remains closed for 1 more month, Brent could hit $120 to $150 per barrel. A 6-week closure could push prices to $200 per barrel. These are not extreme predictions, they're math based on supply and demand. But here's the catch: oil is now in a parabolic rally, and parabolic moves always correct sharply. Last week's surge pushed WTI into overbought territory on every time frame: daily, 4-hour, even hourly. RSI, Relative Strength Index, is above 75, a level that has preceded 10% plus pullbacks in oil 80% of the time over the past 5 years. MACD is showing bearish divergence, price making higher highs, but momentum making lower highs, a classic warning sign of a trend reversal. This is why blindly going long here is dangerous. You're buying at the top of a rally, with no buffer for a pullback. Smart traders don't chase highs, they buy support and sell resistance. So let's lay out today's critical support and resistance levels for WTI crude oil, the most widely traded oil contract, WTI crude oil. Key resistance levels. Today, April 27, 2026, first resistance, $96.20 to $96.80. This is last week's intraday high, where sellers stepped in hard on Friday. It's a near-term ceiling. A break above this zone opens the door to $98. Major resistance, $99.50 to $100. The psychological $100 barrier, a level that has acted as strong resistance since 2024. This is a make-or-break zone. A daily close above $100 confirms the bull trend is intact, but a rejection here could trigger a 5 to 8% pullback. Extreme resistance, $102.30. The 2026 high, a level where long-term profit-taking will surge. WTI crude oil, key support levels. Today, April 27, 2026, first support, $93.10 to $93.70. Friday's close and the 20-period moving average on the 4-hour chart. This is the immediate support. A break below this signals short-term bearish momentum. Major support, $91.20 to $91.80. Last week's breakout level, now a critical support flip zone. This is where bulls will likely step back in. A hold here keeps the bull trend alive. Strong support, $89 to $89.60. The 50-period moving average on the daily chart and the recent swing low. A break below this invalidates the short-term bull trend and opens the door to $85. Now, let's talk about trading scenarios for oil today. No guesswork, just rules. Bull scenario. If WTI holds above $93.10 and breaks $96.80 with volume, go long with a stop loss below $93. Targets, $99.50. Then $102. Bear scenario. If WTI breaks below $93.10 and closes the 4-hour candle below this level, go short with a stop loss above $96.80. Targets, $91.20, then $89. Neutral scenario. If oil trades between $93.70 and $96.20 for the first 2 to 3 hours, stay on the sidelines. No trades in a range. Wait for a breakout. A critical note for oil traders. Geopolitical news can override technicals in seconds. Any update on the Strait of Hormuz, military clashes, or supply announcements can trigger 3 to 5% moves in minutes. So always use small position sizes, max 5% of your account per trade, and hard stop losses. Never over-leverage. This market is too volatile for that. Part 2. Gold analysis, inflation versus safety, critical buy and sell zones. Now let's shift to gold, the asset that's been confusing traders all month. After 4 weeks of unstoppable rallies, gold hit a wall last week, dropping from $4,832 to $4,657, a $175 pullback, before rebounding slightly to $4,702.61 this morning. As we said earlier, gold is trapped between two powerful forces: geopolitical fear, bullish, and inflation-driven Fed hawkishness, bearish. Let's unpack both sides first, then dive into technicals. On the bull side, the Middle East crisis is not resolving. Peace talks scheduled for the weekend were cancelled, and military tensions are rising again. Global central banks continue to buy gold at a record pace. 2026 Q1 purchases were up 40% year-over-year, as countries diversify away from US dollar reserves. This structural demand puts a floor under gold prices. On the bear side, oil at $112 has pushed U.S. inflation expectations back above 3.5%, meaning the Fed cannot cut rates in June as previously planned. Higher rates are bearish for gold, which pays no interest. The US dollar index, DXY, has rebounded from 99 to 101 in 2 weeks, further pressuring gold. This tug-of-war is why gold is stuck in a wide range, choppy consolidation, no clear trend, just sharp swings up and down. And this is exactly why you can't blindly go long here. Gold is not in a bull trend right now, it's in a range, and buying the middle of the range is a losing strategy. Let's break down today's key support and resistance levels for spot gold, XAU or USD, the global benchmark gold, key resistance levels, today, April 27, 2026, first resistance, $4,734 to $4,766. Friday's rebound high and the 20-period moving average on the daily chart. This is the immediate ceiling. A break above this signals bulls are back in control. Major resistance, $4,800 to $4,832. The psychological $4,800 level and last week's all-time high. This is a massive supply zone. Sellers will flood the market here. Extreme resistance, $4,850. A key Fibonacci extension level, where long-term bearish reversals have occurred in the past. Gold, key support levels, today, April 27, 2026, first support, $4,660 to $4,680, Friday's low and the recent swing support. This is the immediate floor. A break below this triggers bearish momentum. Major support, $4,611 to $4,630. The 50-period moving average on the weekly chart and a critical support zone tested multiple times this month. A hold here keeps gold's long-term bull trend intact. Strong support, $4,550 to $4,580. The March breakout level, a major support flip zone where institutional buyers will step in aggressively. Now, gold trading scenarios for today. Simple, actionable rules. Bull scenario. If gold holds above $4,660 and breaks $4,734 with volume, go long with a stop loss below $4,611. Targets, $4,800, then $4,832. Bear scenario. If gold breaks below $4,660 and closes the 4-hour candle below this level, go short with a stop loss above $4,766. Targets, $4,611, then $4,550. Neutral scenario. If gold trades between $4,680 and $4,734 for the first 2 to 3 hours, wait. No trades in the middle of the range. Patience is key. A vital point for gold traders. Gold's long-term trend is still bullish. The recent pullback is a correction, not a reversal. The weekly chart shows a long lower wick, indicating strong buying at lower levels. So if you're a long-term investor, buying at $4,611 to $4,660 is a high-probability long-term play. But for day traders, stick to the range, don't get greedy. Part 3, Geopolitical Deep Dive, how today's news moves oil and gold. We've mentioned geopolitics repeatedly, but let's make it clear. Geopolitics is the single biggest driver of oil and gold right now. Unlike past years, where supply-demand data or Fed policy ruled, today's market lives or dies by Middle East headlines. Let's break down the key geopolitical triggers to watch today and this week. Strait of Hormuz. Shipping updates. Every 6 hours, shipping agencies release data on vessel transit. A single report of increased military activity or another vessel attack can push oil up 2 to 3% in minutes. U.S. Iran diplomatic developments. The cancelled weekend peace talks mean tensions are high. Any hint of renewed conflict or sanctions will boost gold and oil. OPEC Plus production decisions. OPEC Plus meets next week, but leaks are already circulating. Any news of extended production cuts will add to oil's bullish momentum. Global risk aversion. If stock markets sell off, due to inflation fears or geopolitics, gold will surge as investors flee to safety. The bottom line, don't ignore the news. Even if your technical analysis says to go long, a negative geopolitical headline can reverse the trade instantly. Always check the news calendar before trading oil and gold. Part 4, Risk management. The number one rule to avoid big losses. We've talked about entry points, targets, and triggers, but none of that matters without strict risk management. In a market this volatile, 90% of traders lose money because they over-leverage, skip stop losses, or hold losing trades too long. Here are the non-negotiable risk management rules for today's oil and gold trades. Position sizing. Risk no more than 1 to 2% of your total trading account per trade. For example, if you have a $10,000 account, risk $100 to $200 per trade. This ensures you can survive a string of losses. Stop losses. Always use hard stop losses, not mental ones. For oil, place stops 50 to 80 pips below support. For gold, 30 to 50 pips below support. Never move your stop loss further away to avoid a loss. Take profits. Don't get greedy. Take partial profits at the first target, 50% of your position, then move your stop loss to break even. This locks in profits and eliminates risk on the rest of the trade. Avoid overtrading. Stick to 1 to 2 high probability trades per day. Overtrading leads to emotional decisions and unnecessary losses. No martingale. Never double down on losing trades. This is the fastest way to blow up your account. Remember, trading is a marathon, not a sprint. You don't need to win every trade. You just need to win more than you lose, with good risk-reward ratios. Today's best trades have a risk-reward ratio of at least 1 to 2, e.g., risk $100 to make $200. Only take trades that meet this criteria. Part 5. Final summary and today's actionable plan. Let's wrap up with a clear, concise summary of everything we've covered today, so you can walk away with a plan, not just information. Crude oil, WTI, trend. Short-term bullish but overbought. Watch for a correction. Key resistance, $96.80, $100.00. Key support, $93.10, $91.20. Plan. Go long on a break above $96.80. Go short on a break below $93.10. No range trades. Gold, XAU USD, trend. Long-term bullish, short-term range-bound, $4,660 to $4,766. Key resistance, $4,734, $4,800. Key support, $4,660, $4,611. Plan. Go long on a break above $4,734. Go short on a break below $4,660. Long-term buy at $4,611 to $4,660. Geopolitics and risk. Key triggers: Strait of Hormuz shipping, US-Iran tensions, OPEC Plus leaks. Risk rules: 1 to 2% risk per trade, hard stops, partial profits, no overtrading. The biggest takeaway today: stop blindly going long. Oil is overbought, gold is range-bound, and geopolitics can flip the market in seconds. Trade only at key levels. Use strict risk management, and be patient. The best trades come to those who wait, not those who chase. Before we end, let's engage with the community. What do you think? Will crude oil hit $110 per barrel by the end of 2026? Drop your answer in the comments below. We'll pin the best takes. That's it for today's Market Meridian analysis. If you found this video valuable, hit the like button, subscribe to the channel, and turn on notifications. We post daily in-depth commodity analysis and trading strategies. Thank you for watching, and we'll see you in the next video. Happy trading!